Thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, the economic and geographic fundamentals of farm and food, is a continuation of our look into real assets. And as the LP community supposedly suffers from indigestion of financial assets, and the mantra of all the gray-haired gurus seems to be that the world is running out of everything, today we'll hear from three of the most intelligent practitioners that we know of to set us straight. I'll briefly introduce our speakers after I say this. Our speakers' views are their own and do not necessarily represent the views of the Greenwich Roundtable membership or its trustees. So, starting us off today, Lucy McMillan Stitzer is a longtime member of the Greenwich Roundtable and the chairman of Waycross, the investment company for the Cargill and McMillan families. Cargill is the world's largest agricultural company and the largest private company in the United States. Lucy is also a principal of Camlin Capital in New York City, and she's a former member of the board of Cargill, as well as having worked at Sandler O'Neill and Partners, where it's rumored that she donated her bonus to charity.
I do know that.
It was a rumor. Sitting next to Lucy, John Duryea is a portfolio manager at Osprey Special Opportunities, a $1 billion fund launched in February 2006 that focuses on private equity investments across the commodity complex. Before Osprey, John was an original member of the buyout firm Ripplewood Holdings, as well as having been in the merchant banking group within Goldman Sachs. Sitting next to John, Adrian Redlich comes to us from Australia. He's the Chief Investment Officer for Merrick's Capital, a hedge fund based in Victoria, Australia. Before founding Merrick's, Adrian was head of Citadel's quantitative team and the head of Merrill Lynch's Global Valuation and Analytics Group, as well as the head of that firm's pension and endowment strategy and research group. And as we know, the moderator of the Greenwich Roundtable today is Ken Schuer. Ken is the co-founder and chief investment officer of Kenmar, one of the oldest independent fund-to-funds businesses in the business. He's a member of our programming committee and a recovering grains trader. Please welcome Ken as he sets the table for us today.
I don't think you ever recover. So I just thought I'd take a minute to talk a little bit about the change in what we're talking about, the changes that have taken place, and focus a little bit on the difference between secular and cyclical change. I believe that secular change began in the agricultural world. Probably the beginnings of the signs started to show up in the late 90s, even though it was something that had developed as demographics shifted, began to develop much earlier than that. But we all have to be careful about this concept of secular change, because secular change suggests that because of demographics, because of the balances between supply and demand over time, that everything is going to go up. However, as we've seen in the most recent period, that changes quite dramatically as a result of cyclical events. So I wanted to differentiate between the two. And I also wanted to quote something that Bill Callanan from Fortress said to us in July of 2008. He said, "A secular change occurred with the inflection of the demand curve in 2000. Emerging market nations converted from current account deficits to current account surpluses. Then Brazil, Russia, India, and China ascended into the WTO. Consumption picked up, monetary policy was lax, and commodities emerged as a new asset class, all of which contributed to demand growth. Commodity index funds began to shift the market's term structure, which then shifted the reaction function of the producers and the storage agents. The lesson learned was just-in-time only works in a surplus environment only." I think that those words are kind of still reflective 3 years later of an environment that we have today and build a good base for today's conversation. The other thing that I think is worthy of pointing out to everybody here is that we have seen a dramatic shift in the demand side of the market, as we've all seen the Occupy Wall Street diet has increased rather dramatically if you've seen the menus that they've been eating in the papers recently. With that, I'm going to introduce Lucy to start things off. I've been warned not to interrupt her, so I'll be good.
All right, good morning, everyone. Thank you, Ken and Steve. Can you hear me? Can you hear me in the back? Okay. Well, as everyone knows, there have been many questions raised about the media about whether there'll be enough food production around the world to feed a population growing to 9 billion by the year 2050. The focus of this concern has been the diet change, not necessarily on Occupy Wall Street, but in the emerging economies due to increased GDP per capita. The world has also watched in amazement, as Ken just mentioned, about the volatility in commodity prices. But really everyone's wondered, are the days of abundant resources over? But there will be enough calories to support a growing population. However, the central question really is to ask, at what price? In the short run, volatility is created by many factors, such as weather, potential harvest, economic news, currencies, potential regulations, and speculation, just to mention a few. Commodity prices are driven in the longer term by simple supply-demand dynamics. High prices and, at times, ease of entry attracts additional players to the market, creating more supply and eventually eroding the margins. Then, profitability falls to a point where the less efficient players are driven out, supply falls, and the cycle begins all over again. That's the definition of cyclicality that Ken just mentioned. So over the course of the next 14 minutes, I will talk about the effect of governmental policies on food prices and the increasing cost of food production, and why both are important for the long-term price fundamentals. First, I'm going to talk about 3 different government interventions that adversely affect commodity prices: trade interference, lack of food distribution, and mandates. Global trade that is free creates 3 things. 1, country by country interdependence that allows people to enjoy food availability throughout the year. Number 2, food security to those countries that cannot be entirely self-sufficient. 3, it allows for photosynthesis to be harvested and processed at the most efficient location, even if the mouths they feed are elsewhere. Even though 85% of global calories are eaten where they are grown, it is the remaining 15% that are important. For example, Saudi Arabia has plenty of oil, but not easily available water. They have wisely given up growing wheat, so efficiency prevails when they sell their oil on the global market and buy wheat from Canada. Or the Brazilians import wheat and malt for their beer from Argentina. This frees up acreage for soybeans for China. China, in turn, grows their fruits and vegetables locally, but have to import their soybeans. So the Chinese, the Brazilians, and the Argentinians all trust the system, grow what they are best at, trade with each other, and their wealth is increased. When trade is free, the system works well. The price balance falls apart when governments try and control prices for the consumer, for the farmer, or increase revenue for themselves. Like in Argentina's case, the 3rd largest exporter, when the government imposed an export tax of 23% on beans, 20% on meal and oil, farmers protested and supply was disrupted. So one last illustration, the free trade agreements between the EU and South Korea increased European exports by 37% just in 1 month compared to the year previously. So think of what the new FTA can do between the US and South Korea. But if there are enough calories, then why is there hunger? In 1960, the world produced 2,300 calories per capita. In 2011, we produce 2,800 calories per capita for the world. So out of the 10 most impoverished countries, 8 of them are in Africa. Yet these countries have millions of small farmers who can get energized and very excited about growing their crops and selling them on the world markets. Yet their economic opportunities are limited. They have no distribution infrastructure, limited schooling, barely any health care, inadequate government policies, and many times, most of the time, promises to pay rather than the actual cash in hand. You can't run a business like that. So in the poorer countries, only the basic government infrastructure is helpful. The distribution disparity is even more surprising in India and China. Combined, they have 40% of the world's undernourished. Yet India exports wheat, and China has financial reserves of $2.5 trillion. Finally, the third governmental interference are mandates. They create inelastic demand with biofuels as the obvious example. 8% of the world's grain and 14% of the world's vegetable oils are going into biofuels. As a result, all the price adjustments of demand have to come from the remainder of the food system. If we think of the 1 billion starving people today and convert all the calories needed to extinguish their hunger, that would just be 1/6 of the amount of biofuels that were produced in 1 year. The food versus fuel debate has caused enough controversy that the US government has reduced the blending tax credit and the import tariffs on sugar and ethanol. However, whether that's going to work or not is suspect. Really, the true way to make this work would be to get rid of the mandates altogether. But back to the question, is the world running out of food? The prediction of humans starving themselves out of existence is not a new one. In the late 1700s, Robert Malthus predicted that the increase in population is necessarily limited by means of subsistence. What he did not count on were two factors, fertilizer and Norman Borlaug. Both multiplied crop yields. Today, just as in the past, the large growth opportunities revolve around more land under production, fertilizer, and GMOs, which are genetically modified organisms. Again, the question is not whether we're going to run out of food or not, but at what price. So first, let me set the stage for why the diet in emerging economies is important. According to the IMF, 87% of the global population will be outside of the United States and Europe in the next 5 years. As the rural farmers move to the cities and take on new jobs, their GDP per capita increases, and their diet begins to shift. So once people start making $2,000 a year, they start moving to animal proteins. Once they start making $5,000 a year, they go to sweeteners and alcohol. Maybe a little alcohol before then, but anyway. The protein component is significant because of the animal feed necessary to grow pounds of fish, chicken, pork, and beef. For example, it takes 4.5 pounds of animal feed for that 8-ounce steak dinner that you will be having maybe this weekend. To illustrate the magnitude of volume, let's take China. So we all have different views of the GDP growth prospects and the effects of the government's current monetary tightening policy, but some facts can't be ignored. They have 1.3 billion people eating a more varied diet, 14% of global GDP, 19% of the global population. They use 46% of global coal, 50% of hogs, and 26% of soybeans. And it is widely reported that food security is their main concern. So where's the world going to find additional land? As long as prices are high, there will be enough economic incentive to move into land that has not been farmed. Of course, it will be costly at first, which is why prices must be high. There is land that could be developed in the Orinoco River Valley, which is down in Venezuela and Colombia, or in the plains of Kazakhstan. But maybe we don't have to go there. The FAO has suggested that there are additional 5.3 million metric tons of production that's available in North America, South America, Eastern Europe, and Africa, all of which, except for Africa, are our current breadbaskets. There could be double cropping in the US south of the Mason-Dixon line. And both the US and Europe have conservation set-aside programs that could be farmed. When prices are high, opportunity will prevail, and more land will go under plow. How much and where depends on the environmental, regulatory, and social issues, as well as production and infrastructure cost. But it is not just where the land is located, but the yield per acre. When I think about fertilizer, I think about two components, yield and production cost. First, fertilizer maximizes the photosynthesis process with potash, phosphate, and nitrogen. The fertilizer market is anticipated to grow because of the additional protein that I mentioned earlier in the emerging economies, and it maximizes yield on arable land. This is really critical for the smallholder farmers around the world who currently use fish emulsion and manure and will be able to, as their economic situation improves, they'll be able to move to rock fertilizer. So second, potash and phosphate are natural reserves dug out of huge mines, primarily in Canada, Florida, Morocco, and Saudi Arabia. All the reserves that are easy to mine at low production cost are pretty much tapped, and their lifespan has already been determined. So to brownfield or to greenfield, new potash and phosphate production is difficult and expensive. Saudi Arabia is just developing a new phosphate mine. In order to get the phosphate out, they spent $1 billion, probably over $1 billion, to build a 600-mile railroad through the Arabian Desert. That is not an easy feat, very expensive. Mosaic is adding another shaft to a potash mine in Canada. They have to dig 3,000 feet down, freeze a glacial seabed in order to bring the potash back up. Again, this is very expensive and long-term capital that's being deployed. So I would be remiss in not mentioning the importance of the cost of oil as a significant component of the food system. The margins on biofuels depend on the spread between corn and oil. Fertilizer production uses oil as well as natural gas. For every dollar change in nat gas, there's a $33 ammonia price, and ammonia is important because it's used to make nitrogen. As a parallel to fertilizer, much of the easily discovered onshore light sweet crude in environmentally and politically sensitive areas is gone. So you might ask, what about the Middle East? Well, according to a friend of mine who sits on the Aramco board, while the cost of production in Saudi Arabia is $2.50 a barrel, their cost, in order to fund their post-Arab Spring social obligations, has to have the Brent crude price between $90 and $100. So this scenario is not much different in Libya, Syria, and Iran. So to diversify away from OPEC, such as drilling for oil 6,000 feet below the Gulf of Mexico seafloor, or to do horizontal drilling and fracking technologies from nat gas into oil in the Bakken Formation in North Dakota, all of this, again, is expensive. Finally, but the expense for any of the easily obtained oil are due to government regulations and environmental concerns. So oil prices will continue to be affected by social issues in the Middle East and the cost of new production technologies coming online. But while we're discussing input costs, I'm just going to mention in one sentence that water is a central issue in agriculture, as it uses 70% of global available water. Now, the final input is, why are genetically modified organisms so important? So even though they're considered NGOs by others as the black sheep of the commodity world, growing more bushels per acre is possible with GMOs. Their creation is genetic transfer, not selective propagating. As a result, their benefits include increased yield per acre, reduced pesticide and herbicide on the crops, enhanced insect biodiversity, less water, and better opportunities for nutrition. Wouldn't it be nice if those impoverished in India would have wheat with vitamin K and omega-3s? Or Monsanto has stated they can bring up corn yields to over 100% where it is today. So wouldn't it be great if the farmers in the developed world can go from 152 bushels an acre to over 300 bushels an acre? But in order to feed this strain, you need more, guess, fertilizer. Think of GMOs as like an Olympic athlete. You can't be the fastest runner in the world on a bowl of pasta. You need high-protein nutritional shakes, and fertilizer, an additional fertilizer, is what provides that and enables GMOs to grow. So to finish up here, as investors, you may wonder, where do we go from here? The short term is volatile and hard to predict, even for those who have the boots on the ground. It is easy to react to the immediate price movements and think the days of abundant resources are over. As I have mentioned, even in the long-term supply and demand lines have moved up in lockstep, but the price movement itself has shown great volatility. My advice is to think in years, not quarters. If you and your investors are patient, you can be successful. Look for companies that have a history of global growth and very sound risk management. Who are the companies that can navigate through diversified global government structures and still keep their value system intact? Those that have multiple businesses, how well do those businesses collaborate together, not only for efficiencies of scale, but also for customer solutions? Look for companies that can withstand the economic environment better than others, or those who are well preserved to handle their consumers' different economic situations. Carefully examine each step in the ag value chain, moving from seeds, dirt, farming, processing, customer solutions, marketing, and finally to the global consumer. Yes, there are enough acres to feed a growing population. However, the only cure for high prices is high prices. The beautiful fundamental about price increases is that the drive to create more supply produces ingenuity, creativity, innovation, and determination. The next new thing will be invented, and existing techniques will be fine-tuned to produce greater yields, thus feeding a growing global population.
So Lucy, you spoke about You spoke about demographics. There's clearly some location of available land perhaps is or isn't in the right place to grow what we need. We may or may not have water in the right places to make that land productive. And you talked about all of these things, and then at the very end you said one thing that you didn't comment on. You said soil. Jeremy Grantham recently wrote a very long piece about soil and about how one of the biggest risks in agriculture is that actually we have a significant decline in the soil levels. Do you have any comment on that?
I do. In the Ukraine, if you go there, originally the soil was 8 feet thick. It was rich, black. It was absolutely beautiful. So the more soil is farmed, yes, it does deplete, blows away, it has some of the issues. But I think through fertilizer application and through taking no-till farming, I think that the soil can definitely be preserved and used. Soil is not even a remote consideration, at least as far as we're concerned.
Okay.
So,
Actually,
yes.
Good.
And then you go to the Orinoco River Valley, soil's going to be great. You're going to have 4 feet of thick, rich soil. So, no.
Okay, good. I'm going to have John speak, but Adrian, I know you also do some farming, and we've had this discussion about no-till farming that you do in Australia, so maybe you want to comment quickly.
Yeah. So no-till farming, as a quick practice, just to explain to everyone, traditionally farmers till the ground. They rip it up to get rid of the weeds effectively, and keep turning the soil to bring up the soil nutrients. No-till farming is effectively a technique where you don't in fact till the ground, so you don't turn the soil, it doesn't blow away, but you also, when you harvest your crop, in many crops you leave the stubble or maybe the roots or a few centimetres of the wheat stalk in the ground. That decomposes over the following fallow season and creates carbon content in the ground. And so it adds some of the nutrients that fertilizers will also provide, but it also stops erosion and the soil blowing away. In the studies that we've looked at over a 7 to 10 year period, by introducing no-till farming, you can increase your productivity by around 50%. I would say, and this is more of a guesstimate, we know what it looks like in the Western world, but in the emerging world, no-till farming represents less than 5% of production. So there are huge innovation possibilities. We introduced them in Australia, so over half the farmers in Australia who have good access to capital and good education still don't till, because farmers are generally small enterprises. They generally do what their fathers did before them, and so it's a very slow process, but there certainly is a lot of hope.
John, do you want to pick up on that, or do you want to pick up?
Sure. We've in South America we've done the same thing on no-till farming, and the reality is it's the cheapest fertilizer there is. I mean, I think 50% is probably about right. And in terms of fertilizer production and fertilizer costs, and them being tied to the cost of energy, if you think about it, there's less labor in no-till farming, given that you're not, taking things out of the ground. Helps the erosion issue, and basically it's what creates soil. Soil is organic matter. You're just accelerating the decomposition of organic matter and replenishing the soil. So one of the great counters, and there's lots to increases in prices, is things like that, where you're best at bringing down the cost of inputs.
Why don't you pick up with your presentation, John? Thank you.
Thanks, Ken. You had a lot of my stuff.
I'm sorry.
Well, here,
That's okay. That's great.
I just hope you agreed. Otherwise we get an argument.
The macro stuff is exactly right. I mean, just really quickly, my background, as Ken mentioned, is more private equity, so and to me, commodity prices they're the devil or they're your angel, in the sense that if you time things the right way, it's perfect. If you don't, it's a disaster. And I've been doing this a long time. When in the late 80s, with private equity and 90% leverage, if you bought a commodity price business, a commodity price sensitive business, you're out of your mind, because you'd be out of business quickly. So what I've tried to do in our business is figure out ways to play the story, the demand story for commodities, agriculture in particular, where you try to insulate yourself from the prices of commodities, because they are inherently unpredictable. My view is, in the short to intermediate term, they're going up. There's very few things that are going to bring them down. In the case of agriculture, there's a study I saw recently that we have to keep in the next 4 years add the amount of acreage of all of France to our agricultural base to keep prices the same. That's probably not going to happen. So and again, questions of commodity prices should be up, very supportive. The question is from what base? It's sort of the same thing, same sort of debate you might have on taxes, which is, should they go up, should they go down? Where are they now? Sort of should be the first question. Hard to determine whether commodity prices should go up or down from here based upon that. Farmers are making lots of money at these commodity prices, tons and tons of money at these commodity prices. So there should be the ability for them to modulate. But in general, demand for commodities should be huge and prices should go up. But I'm digressing. On the demand story and the volume story for commodities, and Lucy hit on a lot of the math, I call it the middle classification of the world, where you've got countries going from poverty to middle class, changing diets, much greater protein consumption, either directly or indirectly through whether it's beef or cattle or beef or pigs or chicken or fish or whatever it might be. And that's happening. It's happening both in agriculture. It's going to happen in energy as well. As a country, and people get richer, they go from walking to places to taking public transportation to taking the cars. So the demand for energy and indirectly biofuels as an agriculture analogy, that is happening. And that's going to happen whether China grows at 10% or 12% or 2%. That is happening. So the big macro backdrop of unit demand for commodities. Forget commodity prices for a second. I'll come to that in a minute. To me, that's the real way to play commodities in general, agriculture in particular, but commodities in general. But let me give two sort of anecdotes on how we've invested around the commodity business. One, farming, and one in sort of the distribution of commodities. Farming is it's 10,000 years old. We've been farming forever. I mean, some would say it is the world's oldest or second oldest profession, is farming. And we've been doing it for 10,000 years, and the question is, what is it? Does it matter? Is it important? Is it an investable asset class? How does it all really work? The reality is, farming is created civilization. Civilization exists because of farming. So farming enabled us to actually stay in the same place, as opposed to being nomads and going where the food were, going where the grain was, or going where the apples were, going where the animals were. So that made us all stay in one place and created civilization, created technology, and everything else. The question is, for this oldest of technologies, if you will, and it really is an incredible technology, converting a seed, a small seed, a grain of whatever it might happen to be, into calories into food is an incredible technology. So our oldest business, if you will, has enormous technology into it. And I was reading the Steve Jobs stuff that happened the past 2 weeks ago, and there was a great story that was told where he was he'd read a story on locomotion and talking about how man is one of the least efficient animals. The condor being the most efficient, it sort of glides and glides and glides and uses almost no energy to move. Man was bottom quartile of the list. And then, someone had told him about the bicycle, and the bicycle actually makes man twice as efficient as he would otherwise be, and as a result, greater than the condor. And he analogized computers as the bicycle of the mind, given what it's enabled us to do. I think the first bicycle of the mind was agriculture. It's enabled the culture to be what it is. The question is, how sophisticated and developed is farming now per se? In 1860, corn bushels per acre was 30. We harvested 30 bushels per acre in the Indiana Corn Belt. Is sort of for me at least, the main one that I would look to. 1930, 30 bushels per acre. My guess is by the same token, 1,000 years ago it was 10, 20, 30, whatever it happens to be. Now I think the average is 160. There's plenty that are over 200. What happened really with the harnessing ammonium from nitrogen is what created this massive kickoff. It's flattened recently, and I think seeds are the next angle. There's only so much nitrogen you can put on the soil to make things continue to grow. So I think we're sort of peaking that way. So farming has worked. It's gotten better. It's not quite Moore's Law caliber, increasing, but it's up there. And for us, the question was for farming, how is the farm being run? There's plenty of companies that are actually doing well in seed technology and fertilizer development, but is the farm running better? Farming as an asset class is pretty cool. It's pretty interesting. It's got no correlation to any kind of other asset class. Great inflation hedge. You go back any sort of 5-year period, it's always given positive neat returns. But most of that comes from the investable asset class being small, and two, most of the income comes from rent. You're a landlord essentially to the farmer. The question that we sort of focused on was, can you actually run the farm better? Is the farm being run, and to sort of putting the private equity mindset on, is it being run well? And the answer is not really. And we've been sort of working on ways to run it better. Certainly getting fertilizer on, buying the right seeds is right. But as an example, if you level your land completely flat with a laser, as opposed to being off 1 or 2 degrees, when it rains, the water goes in the ground. And when you put on fertilizer, it goes in the ground versus running off. And water finds its own level. And a small variation in land grade makes an enormous difference on yields. Putting storage on your farm, basic sort of run the company better things. Putting storage on the farm where you don't have to sell at harvest. You can actually be there and sell when the price is how you want it is important. Buying things in bulk, having massive commercial farms to buy seed in bulk, to buy fertilizer in bulk, those things weren't being done in large ways. Having offtake agreements with cattle companies or food companies, those things are things that we're starting to see. So as an asset class where you certainly have vulnerability to commodity prices, you are producing the commodity, have vulnerability. Yes, you can hedge commodity price risks. But farming's hard. Sometimes it rains, sometimes it doesn't rain. You can't prevent that. You may have in irrigation. We had one story where we invested lots of money in irrigation in West Texas, and it didn't rain, and it didn't rain, and the well went dry because the water table went below the well. And sometimes in situations where it doesn't rain, you have an irrigation. You're trying to mitigate costs. You water the soil, and the roots come to the surface. That's what roots do in contrast to soil. If you run out of water, then the roots are on the surface, and you lose your plants instantly. Farming's a tough business. It's a great business to model, Excel spreadsheet, acres, yields, input costs, but it never works out that way, ever. So if you can run the asset better, that will mitigate some of the risk. I'm a big believer that corporate farming, institutional farming, is a way that we're going to be better and sort of solve. I think you're right. There's no issue with there being enough calories in it, but there's just not. But a way to run the assets better is through running the farm better. And there's not many institutional ways to play farming that I think are going to develop over the next several years. The other way, I'll give you one quick anecdote about things that are never going to change, because Steve told me how to tell a story. One of the things that you cannot get a farmer to do is give up his tractor, give up his combine. You just cannot do it. And the reality is, here's this massively expensive, multi-$100,000 piece of equipment that's used twice a year. It makes absolutely no capital sense for every farm to have a harvester. The reality is, if you think about the country, things are harvested in the south first, and then as fall comes, it sort of goes up. And what you should do, but it's never going to happen, what you should do is create a company that basically leases harvesters and combines to farmers, so they actually don't have to all the invested capital at once, and sort of have them sort of go up the interstate, highway system, and have it run that way. Never going to happen. So there's things you can get done. There's things you'll never get done on farming, because it's just Adrian's point. Things are always run the way the prior generation ran them. But there are things you can do on the margin. And there is commodity price risk, as I mentioned, which you can hedge. The problem is you don't want to overhedge. You don't want to have more hedging than you have production. It is hard to predict production. So by definition, you have to underhedge, so it's not perfect. The other big move and big investable, I think, way to play the demand story, the volume story for agriculture is really in storage and logistics and handling around commodities. All of the big, whether it's Cargill or Bunge or Dreyfus or EDM, they've got great systems, but at the very end they need to feed, I call it sort of feed the beast. They've got lots of production that actually needs to be fed. The creation of a business in between producers and consumers, a logistics business, is a major opportunity. And think about farming as a different analogy to, any other kind of business that I can really think of. Unlike anything that's produced in a factory every day, produce a razor blade every day, it goes out into a bunch of pallets, goes into a warehouse, and then it's sold out to retail. The asset's produced once a year, yet it's consumed every single day by people, by animals, by whatever it might be. Being in between producer and consumer, providing capital to the farmer, providing hedgeability to the farmer, being able to basically buy well because you can sell dear, is a great business to have. In addition, if you think about it, fertilizer, which is another sort of corollary business, is the inverse of that. Fertilizer is produced every single day. It's mined every day. It's converted from nitrogen every day. But it's consumed once or maybe twice a year to the extent we double crop. Being an intermediary in this sort of inefficiency, this temporal inefficiency between production and consumption, where you don't actually have to feed the beast, if you will. You are the intermediary, and you can actually see these different markets. One enables you to make a great operating sort of commercial margin, but in addition, if you think about commodity prices, the best view in determining commodity prices is the supply and demand. If you've got scale in a business like that, and you're seeing the supply of corn in a particular market or wheat in a particular market, unlike any other commodity like gold, where the price is the same today in London, in New York, or wherever, the price 300 miles different for corn can be $1 or $2 a bushel different based upon local supply and demand, based upon there being a drought, based upon there being a hurricane where the silo blows away. So being sort of in between producer and consumer, seeing the physical commodity, that's the way to trade the financial, I think, because that's ultimately how the prices are determined. So, but a little fast, didn't have too many notes, but in terms of thinking about how to play this demand cycle for agriculture and commodities in general, I think I'm scared of determining commodity prices. I don't know how to do it. It feels right that commodity prices should go up. But on a real basis, over the past 50 years, commodity prices are down. Over 150 years, on a real basis, commodity prices are down. They're certainly up in this most recent incarnation. We've never seen a country like China grow as fast as it is. So many people growing as fast. Little countries, little entities have high rates of growth, but they don't really matter at the margin. Massive countries growing at massive rates have incredible repercussions on the demand for everything. So that would tell me that even though over the long term commodity prices tend to go down because of efficiencies, because in mining and whatever, that feels good to me. To invest on that basis, it scares me. I think Lucy's right. If it's not quarters of years, it might be decades. To me, the multi-decade story around agricultural commodities is take advantage of the demand story, touch the commodity, make a toll on the commodity for storing it, own a port asset, develop a port asset, whether it's in our country or in different countries. And the U.S. is really the place to do this. The U.S. is probably, farming in the U.S. is our most competitive industry. We're exporters of corn. I mean, and we are the lowest cost producers of corn on the planet because this country is blessed both with great soil, with great weather, and great natural infrastructure in the form of rivers. The cheapest way to transport both commodities is on a river. It's it's a penny per ton mile versus 2 or 3 pennies per rail and 20 per truck. We've got this great both natural and built infrastructure. And that is our advantage. We've got to, and to your point about regulation, we've got to enhance, not detract from the U.S.'s ability to produce agricultural commodities. It's the infrastructure, though, to me, versus predicting the price. That's the interesting place to play. That's right.
John, you spoke about storage, logistics, and transportation. In your business model, will you invest in that part of the in that part of the chain, or are you really focusing more on the farm and
We've done both. We've done both. We've got in the U.S. the notion of running the farm better, which I mean, they're great businesses built around seeds and agricultural equipment and storage and whatever. But the run the farm better model, that's really the counter to, gee, our ag price is too high or our acreage price is too high. We are doing that. We're doing it here. We're also doing it in South America on the no-till side and some real scale. South America the yields are different, the soil is not as good, the infrastructure is not quite as good. I would want to invest in infrastructure in South America, and we've got a great system of rivers in this country where there's no falls, essentially. But around the river valleys, the reason why we've got this great system is because there's very little. You would probably know this being a Minneapolis person. What's the sea level difference from Minneapolis to New Orleans? It's like 400 feet or something. It's irrelevant. In every other country, like in Africa, great soil, great climate, impossible infrastructure. I mean, absolutely impossible infrastructure that will take billions and billions of dollars to build in different decades. So it's a great concept, I think, and to feed locally, it will work. And bringing an African farmer's yields up to the levels that Lucy mentioned is a great way to feed locally, but to make a dent in the export market, I think, is a challenge. On the infrastructure side, we are doing that. I mean, there's all the businesses that I mentioned, ADM, Monkey, Cargill, et cetera, terrific businesses, awesome businesses. Seed companies, Monsanto, terrific business. I think over the long term they'll do well. We're creating a business around the infrastructure that I was mentioning to you, and you have to do it on a real scale. So both is the answer to your question.
Just to give you an example of what John said, I started trading corn in 1975. In 1975, corn was $2.50 a bushel. In 2007, January the 1st, I believe corn was $2.50 a bushel.
Well, then say what happened in...
You're leaving out part of the story.
We all know what's happened in the most recent past. Adrian, you want to pick up on that?
Sure. So I think both John and Lucy have spoken a lot about the structural themes around fertiliser, lands, government. What I'd like to do is touch on 3 areas. I'll come at it more from a trader's perspective. We run shorter term trading strategies in trading agricultural commodities as well as investing in equities throughout Asia. And so we're very focused on the Asian consumption in particular and what's going on and I thought I'd try and add to it because I have a lot of similar thoughts in terms of structurally, but add to it where what we're seeing going on as far as investment's concerned, how people are investing structurally, but the impact it has very short term in terms of commodity markets in particular. So I'll touch on 3 areas. Structurally, the second where I think there's some major structural changes from investors on markets. And lastly, I'll just give you some thoughts on where I think we are in the cycle, because investing in commodities is a boom-bust business. No one should enter this business lightly, whether it be in farming, logistics, trading commodities. It's the nature of that slight imbalance between supply and demand, and it is boom-bust, and we always get a phase of inventory destocking, which will take us below marginal cost, and vice versa. The obsession with just-in-time inventory will take us the other way. So it's always timing. As one of my farm managers says to me, the only thing that counts is the price you buy it. There's nothing you can do once you own that farm in terms of improving efficiency. If it's bad land and you've bought too highly, you're going to have to live with that. It's very painful. So when it comes to, and John could probably talk a lot more about that on the private equity side, your entry point is all important. So in terms of structurally, a couple of things to talk about. Commodities is, as I said, boom-bust, no doubt. The amount of information I get every day on supply is mind-boggling. I sit in Australia, I sit 10,000 miles away, and I'm getting Twitters and blogs and chats from people doing field tours in Iowa. Within seconds, we're hearing about how many bushels, what are the bushels per acre, what's the supply, how much storage is there, how much is in storage. The supply side is where commodity people live, generally, and it drives markets short term. Demand, we sit here and we talk about demand. In 50 years, the world's going to need 5 times as much food. There's a massive chasm here that we have to deal with between dealing with this instant information flow around supply side, but yet demand is so difficult to manage. And it's for that specific reason, that unknown element of demand, that always leads to boom bust, because it's very difficult to measure. That's not specific to agricultural commodities. That's our economies in general and the environment in general we live in. But it's particularly more challenging as you have China and India, in particular, becoming huge consumers of food. As Lucy touched on, China's gone from importing effectively zero soybeans to 25% of the world's soybeans, which come from South America and North America. And so understanding those nuances is clearly important and the entry point. In terms of the interaction with energy, I want to touch on this from, I have a slightly different perspective, I think, to a lot of people who I meet with each day who are looking to invest in commodities. The reality is, if 150 million tonnes or 5 billion bushels of corn didn't go into ethanol in the US, we would actually not have high commodity prices. It's just, you're talking about, of coarse grains in the world, you're talking not quite 10% of the world's coarse grain supply that over the last decade is going into gasoline. Now, I think as a policy decision, it's successfully displaced Saudi Arabian imports as the #1 non-domestic oil supply going to gasoline, and in many ways we would argue that increases national security and lots of things. But it's very important to remember as we talk about the growth in population and the demand for food, that is a very slow burning trend. And the reality is that 40% of corn in this country goes into ethanol. Some 30% is sugar in Brazil. Brazil produces 50 million tonnes of 125 million tonnes globally of sugar production. And some 30% of that Brazilian sugar supply, so some 15, 20 million tonnes, will go into some 15% of the world's sugar supply, goes into ethanol. And we have silly situations. Here in the US this year, effectively we've been exporting ethanol from the US to Brazil because Brazil introduced a mandate to have a minimum of 25% of all gasoline coming from ethanol. Suddenly we had a severe weather event in South America, sugar was short, the mandate was still in place, and so we actually started exporting ethanol from the United States to South America. And really the only thing that made that stack up was effectively a government subsidy. So Lucy touched on the impact of government and where it's at. So we need to be very careful in terms of why sugar trading at $6.50, $7 a bushel rather than $2.50. What's been the key driver? And so just balancing that in terms of your entry point. Personally, I have bought farms in Australia. Is a more arid country. It doesn't have the benefits of the Midwest here that John has touched on. So you have to be a little more sensitive at your entry point. I've had a simple philosophy when I joined a commodity trading desk in the early 90s. A group of us, we basically had a philosophy: buy farms during droughts, sell them after 3 years of good production. And we were in an environment. The 90s was a horrible place for commodity traders, for commodity investors. We had destocking of, from post the fall of communism. We had excess supply around the world, and now we've moved to the reverse situation. So I still have some of the scars from the 90s. Commodities being a much tougher environment, and so I personally believe you have to be very selective and targeted, because we now are in an environment that, due to government initiatives, more so than anything, commodity price is very high. It doesn't detract from the structural issues that are going on, the long-term structural play, but the impact of mandates, particularly around energy, is critically important. So it's one thing to be very focused on. We've touched on farm innovation, and it's clearly evolving. Just to give you a couple of statistics around Asia, particularly China, it's getting a lot of attention right now as being a potential importer of corn, which could change the supply-demand dynamics globally. Currently, the US is the biggest producer of corn by a significant margin, approximately 350 million tonnes. The Chinese are the second biggest producer. They produce around 180 million tonnes. And they clearly have a major issue in terms of looming with corn shortage. But one of the key reasons for that is that they have a herd of around 450 million hogs, some 10 times the size of the US hog herd, and it's a critical staple food. One of the things that they're grappling with at the moment is very high pork prices. Pork prices are the single biggest impact on inflation in China, which is the single biggest, in my opinion right now, has the single biggest impact on money supply in the world. The Chinese have actually printed more money than anyone else, ironically. Money supply has grown by 120% over the last 3 years, and the velocity of their money, because they're optimistic, they want to invest it. The rest of us in the Western world are putting the money under the bed. We're worried that governments, we've got to counterbalance government. So as the Chinese deal with inflation, it's having a big issue in terms of trying to contract money supply. So coming back to the impact on pork, it would be very efficient for the Chinese to import pork. It makes sense. They could actually solve a lot of their issues, but they've been very reluctant to do it in scale, because it would take more and more people out of rural areas. It would proliferate the rapid expansion of urbanisation. But also, the most important thing in China, and we, my team, we probably spend, we do about 20 trips to China a year. The most important thing we hear constantly is keeping the rural population happy. It's the single most important thing when you talk to, in terms of the politicians and the bureaucrats, because they fear uprisings. And where does that come back to in terms of pork pricing? Well, you could import pork more cheaply, but at the end of the day, they want to keep people gainfully employed, so they'd rather import corn. And so it's not efficiency gains, and we touched on around farming, but quite often it's not necessarily the logical driver of what we're seeing. So we are going to see the Chinese enter the corn market. The US actually will be the biggest beneficiary, and maybe we'll see, as they enter that market in a balanced fashion, we'll see the reduction in ethanol demand as a mandate, and we'll see I'm somewhat hopeful of a logical transition, but I'm pretty sure in the end, like most commodities, it will be boom bust. But it's a critical element. But the key thing we look at for investing, when we think of structurally investing, John touched on it, it's about moving oversupply in certain parts of the world to undersupply in others. It's the greatest opportunity, in my mind, for a long-term investor, in a private equity sense, a structural investor. It's how you want to invest. You want to identify where there's the least supply in the world and where there's the oversupply, and how does that move from one part of the world to the other. And certainly logistics is one key element. We recently met with some people who farm in Zambia, and just to give you a sense of it, Zambia supplies around just under half of Southern Africa's water, so the catchment area for Southern Africa. Southern Africa, and many of you may know, South Africa is quite short energy. There's actually some severe commodity issues as they have a growing population. But Zambia has proliferation of corn. It grows lots of corn because corn is grown during the summer. They naturally are able to grow corn. But because wheat is a winter crop, they can't actually grow any wheat because it doesn't rain during the winter. And so you have a crazy situation where wheat trades at 3 times the price it does in the US, yet corn trades at a discount. So the global balances that you see, moving wheat into Zambia, through Durban in South Africa, up through the route is a critical driver. Investments in that style of thing to basically supply the bread supply and grains is one style of investment. Now that's at the outer limit, because Zambia is not for the faint-hearted in terms of investing, but we see those things in many places. So I think logistics is the answer. Owning ports, it gives a pretty stable return, and it will participate in that long-term upward growth that we see. But it reminds us boom bust. Now I wanted to move on to talk about a couple of structural things we're seeing in trading commodities, and this is the space that we really live in. And I'll touch on 4 areas. The first, which doesn't make any sense to me, is that a lot of my old clients, when I was involved with pension endowment strategy at Merrill Lynch here in New York, and I speak to a lot of the pensions endowments, their investment in commodities as an asset class very concerning to me in terms of buying index exposure in futures, buying passive exposure. On our tracking globally, we now have over $100 billion of passive money tracking agricultural commodities. The corn crop in the US, just to give you a magnitude, is around $60-70 billion a year. Soybeans around $50 billion. I mean, these are big numbers, particularly when the majority of the money is going to Chicago and New York. It's going into soybeans, sugar, corn, and then it tails off quite dramatically. A little bit of cotton. It's having a significant impact. For us as traders, we sort of look at it and say, long may it live, because the reality is things like Chicago wheat trade at a big premium to wheat in Japan or Australia, yet the Japanese contract or Australian contract for wheat is in fact a higher protein wheat, higher quality, and in fact closer to a lot of export markets and has a freight advantage. So we see this index money investing and driving prices, but I just don't understand how long term it's going to make money. It's inefficient, it's creating price dislocation in one market versus the other. It's nice for us who trade those relative value geographic spreads, but I don't see how people are going to make money when commodities long term decline in a real sense. It doesn't mean the volume story is not there. It doesn't mean we're not structurally going to increase maybe at a more rapid rate than we have that period from 1980 to certainly through to 2007. But it's really I think it's a function of investment banking, quite frankly, and I spent 12 years with Merrill, so certainly was part of that, and we all get caught up, what's the correlation benefits, where do commodities fit? And it's the easiest way to invest for a lot of people. It's highly liquid, it's a diversifier in their portfolio, but quite frankly it's efficient. It creates huge inefficiencies which we're able to take advantage of, but it's not a particularly clever way to invest. The challenge is most people then jump to the other extreme and say, well, there's only a few style investors who will invest with John, and say, well, I'll lock my money up for 10 years. And so that's the challenge we face as investors in this space. And it certainly drives people to be bigger investors in fertiliser companies, logistics, listed equities, I think is one of the areas. But that index money is creating enormous distortion. We see it every day. The second area I touched on earlier of distortion is the east-west sort of information flow. We are too fixated on what is going on here in the Midwest of the US as a global market. I talk to people trading palm oil in Singapore, and the first thing they'll tell me in the morning of what's going on in the Midwest of the US. The US is so efficient. It's whether it be infrastructure, trading, and also information flow. Whereas an understanding of what's going on in China is much more challenging. And that's an area where we constantly see misinformation going on, and it's an area where I think that there continues to be a lot of opportunities. To give you an example, there's a huge amount of investment right now in traders being long soybeans and short corn. Soybeans are far less profitable to grow at current prices than corn. There's an expectation around supply-demand that people will grow a lot more corn next year. It's just the logical behaviour. But part of the reason for soybeans being somewhat depressed, and still at a relative elevated price, but depressed relative to corn, is that the perception that Chinese have stopped importing as much soybeans. And so when you do trips to China, it becomes very apparent that they, being a player in the soybean market, have decided at the beginning of this year to put price caps. They were sold out of soybean oil on supermarket shelves. There was clearly demand, but they believe that inflation is almost an arithmetic problem, not a monetary problem. And if you keep prices flat for a year on year, then you have no inflation. Which we all know that just doesn't, it'd be nice. It'd be nice if we could solve the problems in that way. But for those that spend their time on the ground in China, they've just increased soybean prices because, you may recall, commodity prices spiked last September, October. We're now year on year flat pricing. So therefore prices have been allowed to rise. And suddenly I think we're going to see a wave of soybeans head to China. And so I think the understanding of what is going on in that market on the ground is a critical element. But there's a constant misinformation. The market reacts very quickly to what goes on here and very slowly to what goes on in China. The next area I touch on and is very important is in terms of tight credit or lack of capital. Many of the proprietary trading desks or broking desks that we trade with aren't able to facilitate the positions that they were several years ago. With Basel III introduction, Dodd-Frank, Volcker rule, a whole range, the capital being applied to the commodity space is actually shrinking, and shrinking quite rapidly. So we're seeing spreads and relative value trades taken less advantage of by the likes of the prop desks, but we're also seeing less facilitation for a lot of the industrial and consumer clients of a lot of the big banks. And it's creating a lot of opportunity, but at times it creates much steeper forward curves, and sometimes the best investments we can find is actually just buying wheat and a storage facility, putting it in storage and sell it into the futures market a year forward, because the contango or upward sloping curve in wheat right now will yield you around 20%, and your only risk is that the futures market is going to go belly up, which is unlikely. Now that's very unusual. It's maybe part of that environment, the broader environment we're in, where lack of credit provides lots of opportunities, but we're certainly seeing it in commodities, and we see it as a smarter way to invest than simply being long futures. I'll touch on just short term, finish up, maybe market positioning. Commodities, and agricultural commodities in particular, is an extremely crowded trade short term. And when I mention that to some of my investors, they look at me and say, well, surely we've had a clean out. We've had some pretty dramatic sell-offs in the last 4 or 5 weeks. September was a pretty aggressive month. The reality is, structurally, when you sit down with almost any strategist from any investment bank, you sit down with any macro thinker, too often I hear the same commentary. We know Europe's got problems, know the problems in the US, we know how the world's positioned, but structurally emerging markets is a great place to invest long term. Commodities is a great place to invest long term for the things that for the core reasons that we've touched on. But what that means is that we still, we certainly haven't had a clean out. We still have huge, I think, more passive money crowded into commodities at the moment. And so the fear that I have is we have this very good structural long-term story, but we're on the precipice of a pretty severe downturn. The tightening bias is still very much going on in China. All the companies we invest in that part of the world continue to tell us on a daily fashion that credit gets tighter, money supply is tightening. Commodities, it would be very unusual not to have a peak to trough drawdown of around 50%. We've seen a drawdown of 20. It would be a highly unusual cycle. And I think Ken touched at the outset about a cyclical environment versus a structural one. And for those of you that haven't invested in the agricultural space and are contemplating it, I do believe the next 6 months is going to provide enormous opportunities, because we're going to have some pretty severe sell-offs in our opinion, because it's an extremely crowded space. And there are many ways you can measure that. And for those of you who like the technical aspects, if you look at the energy market has very steep skew in option volatility. What does that mean? It means out-of-the-money options are priced quite expensively. The Saudis and many others are buying put options on oil. They have fears of a dramatic fall-off. Protection. They're buying insurance. In the agricultural market, farmers are actually selling volatility, actually selling insurance. Now, that might sound like a strange concept, but the banks have done a fantastic job of selling them all these structured products, and they're actually selling volatility to try and capture some income. So what we have is a market, a technical market, where there's very low insurance premium in agricultural markets, very high insurance premium in energy markets. It's just another measure that we see in many ways that agricultural prices, in our perspective, in our view, will fall quite precipitously in the coming 6 months, and will give you actually a great structural entry point. Because as I said at the outset, the price you buy at, particularly if you're looking at the private equity side, is all important. And so that's certainly how we see the world at the moment.
Thanks. I have several questions, but since we're running a little short on time, I thought I'd open it up to the group here. Yeah.
One thing that I think you've clarified is a lot of the training in economics, but in terms of the long-term view that needs to be taken, isn't that also pushed forward by the need for innovation? And innovation generally comes from R&D. And R&D in agriculture seems to be underfunded if you compare it to other fields like healthcare, pharmaceuticals, and medical devices. Do you see that as a part of one of the moving parts in this puzzle, that there's not enough R&D either on the industrial or on the academic government level? And is that an issue that you think will have an effect one way or the other?
Lucy, you want to start?
High prices create opportunity for more people to enter the market. And one of the key technologies is called precision farming. So when a tractor or a farmer drives his tractor over the field, he can take samples along the way and determine exactly what kind of fertilizer or water application that particular little quadrant of soil needs. So then he goes back and can do the right application. So that is not, it's not wasting fertilizer, it's not wasting water, it's doing a full analysis of your field based on GPS technology, and so that kind of thing is occurring. Or same thing with dairy farming. With the milk yields, you can analyze the manure of a dairy cow to the exact specs, so you can get the cow to produce, this specific amount of 75 gallons a day, or what you're requiring them. So I think that technology it's not sexy, or most people don't think it is, and it's not as exciting, because it's not like Apple or it's not Steve Jobs, but it's definitely there. I would agree. So,
John, you have anything you want to add to that? Or?
Not really.
I'll just add one. I think around certain industries. So corn, soybeans, we've seen enormous innovation. Rice and wheat, we see very little R&D spend. And if you think about rice in terms of the demand for rice, where it comes from, their ability to pay the royalties to the likes of Monsanto, there's some areas there where governments probably need to intervene, whereas I think high prices and capitalism does a very good job in certain markets, in others it's challenged.
You know, one thing to remember is that the yields in the U.S. and the developed part of the world are pretty good, and you know, Monsanto and the new innovations, the new technologies are keeping up with that. But there is the rest of the world that have very small farmers with no infrastructure, and they're just trying to get the same yields or even remotely close to the yields that we're getting today. So Mexico has yield equivalent today of corn that we did in the 50s, or in parts of China that we did in the 70s. So the rest of the world has to catch up, and that's really a key.
That's a good buffer.
Lucy, you point out that bad government policy seems to be a major obstacle to all this. First of all, what are the origins of that? Is it just inertia? Is it lobbying? Is it fads? Some combination of that? And second, are there any, then I'm talking worldwide, second, are there any voices other than your own, institutional voices, pointing out what rational policy would be? Is there any hope that they'll have any influence?
Well, to answer your first question, I think that governments have the best intentions to protect their own farmers or to protect their own suppliers. So I think that that's what they try. However, in Argentina, the example I gave there, they just wanted to increase their revenue. So they just threw on a soybean tax. So that was not beneficial, certainly not the farmers and certainly not anyone there. The Ukraine puts on a VAT tax. I mean, or people will put on a tax just to keep the price high so people can't import. Originally, but I think there are other voices out there. All I know is what we're doing, and when we meet with the different governments around the world. We don't go with, hand in hand with ADM and go meet with the governments. We're just on our own. And I think through our value system and through our production and through our economic enhancements that what we've done in the governments, people listen. I mean, particularly, I can talk on this for a while, but I don't want to. There's in Ivory Coast, in China, in Venezuela, believe it or not, we have a decent relationship with the government, even though they've taken some of our pasta facilities and some of our other things. But we still, you can still manage it. But I think for us, it's on a company by company basis. There are no groups.
So, yeah.
One question about government subsidies in the U.S. How big are they? Who are the beneficiaries? And what happens to the whole equation if they're substantially reduced?
Well, right now the price is high. The subsidy right now, because prices are high, farmers are not receiving the subsidies. So for milk or for corn, I mean, you guys can answer this better, but I mean, so it's a non-existent issue. It's really when prices are back down to $2, or milk prices are down to $12 or $10, maybe the subsidy kicks in. But right now, it's not occurring, and I don't foresee it in the near future.
The exception would be ethanol, and there still is the blender credit there.
But that's falling
but
off.
it's supposed to be going away by structure. I don't think the farmer ever got it when it was in place. I think it went more to the blender economically. But sugar is still substantially supported in the U.S. market. That's right to the farmer. That makes no sense. I mean, I think I'm not sure that's going to go away. I'm not sure sugar is, but that doesn't seem like it's going to go away.
Just to give you the magnitude, ethanol sells for $2.70 a gallon. The blender's credit is 45 cents a gallon. Ethanol would be still profitable for blenders without that at the moment. It does expire in December. It would require a new act of Congress to put it back in place. The magnitude of that credit is around $8 billion a year. Is the size of the subsidy, which will disappear.
Yeah, and I guess I put the word subsidy, the new subsidy in quotes, which is we have this mandate where we are required to have ethanol in our gasoline, 10% going to 15%, which creates this unfair on inefficient demand for corn. And ethanol, corn-based ethanol is massively inefficient. I mean, both from a combustion point of view, from a production point of view. So in terms of a subsidy that supports corn prices and the farmer, that effectively the demand and the requirement that there be ethanol blended into our gasoline, that's there, and that's not going to go away, because the things that are behind that are, it's renewable, which is great to have renewable energy, and it theoretically gives you an independence from foreigners' oil, and that's not going to go away. I don't think.
So I'm going to just, Steve, I'm going to let you ask a question, but before you do, as the regulars here know, I have an interesting interaction with Steve when I sit up here, and I feel, Steve, as if we need a warning label.
Okay.
And the warning label goes to the panelists. Steve is supposed to ask a simple one-part question. It will have 3 or 4 parts to it, no doubt. You may or may not understand what he's saying or what he's asking, and you are allowed to say whatever you want afterwards, and it may or may not be relevant to his question.
The opinions of the Greenwich Roundtable were not mine, and I'm not sure if everybody remembers where they were when the golden arches first flew over Beijing. But I don't know if you know, but there's going to be 1,000 new Starbucks in China in the next 2 years. So it ties into one of the 2 questions I have. First one, what is the role of diet and religious and other kinds of issues in Indonesia and China in terms of the middle classification of this and how it impacts some of the food chains and whatnot? And secondly, how important is the price of oil and the cost structure of all of this, and what's going to happen with that?
Well, with the first part of the question, here's the way to really think about it. As economies get wealthier, as a country goes from poverty to the middle class, historically what happens is the diets change. If there's more money to spend on food, you eat differently. You go from a grain-based diet, basically eating rice, essentially, in terms of China and Indonesia, to having more protein-based diet, protein from animals themselves. So in terms of actually getting the conversion, if you will, in order to actually grow a pig or grow a cow, if you will, to actual harvest weight, requires multiples of the units from a calorie basis, units of grain that actually goes into it. So it takes, for example, the equivalent of protein equivalent of 8 times as much grain calories to grow the cow as it does to actually grow the grain of corn. So the actual geometric demand as countries go from poverty to the middle class, and their demand for protein increases, the demand for grain is not just 1-to-1, but it's multiples of that. So the demand, as a result, globally for grains to go to those countries or to be produced themselves. China this past year, I'm not sure what the total amount was, but was a material and growing importer of U.S. corn. So as I'm thinking about sort of the places where you want to invest and risk capital, there's plenty of places to do that in those growing emerging countries. I'd much rather do it from a place you live, supporting basically the growing emerging market economy's growth from a U.S.-based agricultural base. I think that's the better way to play the investment, if that was your question.
So culturally in Indonesia or religiously, that's not going to have any significant impact because of the religious and cultural issues in parts of the world where they don't eat pig and pork and meats and et cetera. That's not going to be, that's a bump.
Well, I don't think they didn't eat it. I mean, I can't answer the religious part, but they didn't eat it because they couldn't afford it. And remember, when you start making $2,000 a year, just $2,000, that's when you start bringing in more meat. And it doesn't have to be meat every single day, but it's meat on a more consistent basis. And then $5,000 a year, I mean, that's just not a lot of money. Mm-hmm. Then you start eating sweeteners and alcohol. But as far as having McDonald's and Starbucks, I think it's a good thing, aside from the fact that whatever people think of McDonald's and whatever people think of Starbucks. But what it does is it brings in a new standard of living, a new standard of cooking, of cleanliness, of best practices in food preparation to the area. You go to, if anyone, I'm sure a lot of people here have been to the wet market. The wet market is just a food safety nightmare. And one of the issues in the world is the globalization and the harmonization of food safety standards. So you have McDonald's and Starbucks there. They have very stringent food safety standards that will be implemented then at the local restaurant, which are implemented at home. And so there's a whole other cultural infusion, which isn't just obese people drinking Cokes. It's a better level of innovation, food safety. And
Price of
culture.
oil and the impact of commodities?
Well, I ended a little bit just talking about the price of oil affects fertilizer, it affects the managing the inputs on the tractor, it affects, I mean, it has all roads lead to oil, to be honest with you.
There's a lot of transportation.
And it's transportation, you know, the whole infrastructure. I mean, we have, as John was saying, we have the Mississippi River, it's great, but you have to maneuver around Iguazu Falls in Brazil. You know, that's not, you can't just be James Bond in a glider. I mean, that's major infrastructure. Changing and getting things out of Peru, getting fertilizer out of Peru. That's no easy feat. So that takes oil.
Yeah, go ahead, quick.
Just, Lucy, how much infrastructure would Cargill own? Would you actually go and own a port? In what cases would you consider owning heavy assets like that in order to facilitate it?
We own ports. We own ships. We own barges. We own train cars, rail cars. We own and lease just about everything on wheels, and anything that moves, basically. I mean, it just depends, and it depends. I think one of the questions that Adrian mentioned is really where is the most efficient and best use of your production facility, and you know, the best way to have hogs is to do it over here. It's just to do the whole hog situation from the beginning to the packaging and then ship the packaging over there. But that's not going to happen because of the social infrastructure. But you think of Zambia has the most water. Well, that's the best place to grow corn, that's the best place to manage and then ship it out. So from a pure play point of view, it's best to do the production and the facilitation at the location and then ship it once it's produced. But that's just not going to happen. So I don't know if that answered your question, but I think you need a full-scale infrastructure system.
Rob, I'm going to have to cut it off after Rob.
Just a quick question. The theme is very compelling. When each of you underwrite your deals, what type of returns are you looking for?
You go first.
Chicken.
So I'll touch it in two areas. In terms of providing liquidity to market and trading commodities, that's somewhat different. That's more a highly liquid markets, you know, sort of looking on average, hopefully net of everything, to make 12-13%. Right? It's a different paradigm when you provide liquidity to a wheat market that needs to store and carry that wheat and finance it at low cost. We're buying, and I'll answer the farmland way, farmland in two regards. Buying farmland itself, I kind of split the land versus the operating entity, and buying farmland is like any other land play. Look at it and say, you know, it's probably a 7% returning style investment. It's quite low risk, and part of that is made up by rental and part by capital growth at the moment. It's not high, and I think the reality is, if anyone goes into it thinks it's high, I think, you know, the type of things John's doing in South America, it's different. If you add a huge amount of expertise to it and really turn something from low quality to high quality, that's different. So operationally at farming for us goes from, and we look at all input costs, and in terms of renting the land, even if we own it, we charge rent back to the operating entity. The returns, they're annual returns, and so over the last 3 years, they've varied from -25 to 100 plus 120. I mean, it's boom bust. Weather, commodity prices, that's it. It's all over the shop. But I think when you take those numbers over a long period of time, it's the mid-teens average.
Yeah, for us on the farming side, the pure farming side, you're right, it's probably high single digits. Adding extra things to the farm from running it better, if you will, probably gets you in the mid-teens on the run the farm better model. For all the other things, we're buying companies. It's 20% plus is the objective.
Well, we're private, so we have a different model. But I'd say our public objective is to double the size of our net worth every 5 to 7 years. And we have to do that because we are private and we have to use our own internal capital to grow. So that's just a function of survival. And we end up doing that. So we're doing okay. And it turns out to be we're in the mid-teens as an average return. Not every single year. Sometimes some years better, some years worse, but over a long haul.
Those are good
So
numbers.
we're right along the lines with you guys.
I want to thank the panelists. I think this was really good, really great group. Everybody brought some very different, interesting perspectives, and I'll turn it back over to Steve.
Thanks, Ken. Since what year, Lucy? 1865?
1865. yes.
1865. Not bad. It's a good run.
Do I look that old?
Our lovely and disciplined Sergeant-at-Arms, Connie Sledge, reminds you to please fill out your comment cards. On November 22nd will be our next session. It'll be Mark Silverstein's committee, the Education Committee. We will release best practices. Subject is managing complexity. Hope to see you here. That is an evening session. And on a personal note, about 10 years ago, I'd mentioned to Lucy's husband, Mark, that we were going organic and that they didn't know anything about corn gluten meal. And the next thing I know, I see 3 bags of corn gluten meal in front of my barn. John's wife, Wendy, had mentioned that their soil was heavy in clay, and that I felt compelled to drop off some green sand to deflocculate the soil. So it's all full circle. But in 2002, we sat in this room and heard from our first session on hard assets, art, timber, and water. And Peter Sutton reminded us, investing in art, that it's not really a good investment, but it pays dividends of pleasure every day. There's an aspect of agricultural investing that I think is very interesting. It's called agritourism. And as Lance and I and Ingrid, we've just gotten back from Tuscany, it's very, very interesting. And as a testament to this session, I think it's a very intellectually stimulating area to invest in. I would recommend, thank you, Lucy, for popping the bubble on GMOs. There's a book called Lords of the Harvest. I recommend you all read it. It's basically the story about some bad corporate behavior, specifically by Monsanto, and the backlash in Europe against GMOs. And GMOs are actually very beneficial to the whole process. Corollary to that, Guns, Germs, and Steel, about the rise of the Fertile Crescent and why Europe is such an amazing phenomenon in the world. It all ties back to this agricultural theme. Finally, I would like to welcome Brian Fitzgerald into the Roundtable. Here's our newest member of the Roundtable. Welcome, Brian. Our annual meeting will be held on the 14th of December. We've got Howard Marks and Ken Rogoff come in to talk about the regime change that's going on. And finally, and most importantly, I'd like to welcome Kelly Ireland to our group. Kelly is not from Ireland. He works in New York. He's from New Zealand. He works with HedgeServe, and through Bob Aaron's leadership and initiation over 12 years ago in underwriting the Roundtable, HedgeServe is continuing that tradition with us. And I'd like to welcome Kelly. And Kelly, would you like to say anything to the members today?
Sure. Having grown up on a farm in New Zealand, this was particularly interesting. But yeah, HedgeServe really appreciates the opportunity to be involved with the Roundtable. It brings industry leaders together and allows thought leaders a great platform to share some insightful commentary. So thank you.
Thank you, Kelly. And I just would like to mention to everyone that Bob Aaron has just gone through some very difficult surgery. And please send your positive energy to him. He's recuperating. But Adrian, thanks for coming from Australia. John and Lucy, very good job. Thank you.